By the way, also on Sunday's paper, it said first home buyers unable to break into the housing market this coming month may find it even more difficult to buy next year as prices continue to rise. And this is a core logic and head research. She's saying surging rents, increasing home values, which she thinks are going to go higher. Mind you, I think I remember her saying 2 years ago they weren't going to go higher. This is a very, very challenging time for first home buyers because they can't get into the market because there's nothing available. It keeps rising. And I've got to say, I do remember very clearly when you said what you said about prices. Also, all the experts said, oh yeah, we're seeing a 10% cool off in the next 12 months. They all got it wrong. So you're not alone, Martin. You're floating there with a big party of people. But anyway, it's funny that Elizabeth Owen, because I remember she was one of the leaders that was saying it was going to go down, and now she's saying it's going to go up. So anyway.
Well, let's be clear. Data changes, and as data changes, you need to react. But the point about first-time buyers, the average first-time buyer today, if they rock up on their bank, they will be able to get 40% less by way of a mortgage for the given income relative to what they could do before interest rates started to rise. And that's to do with borrowing power.
They don't mention that in this article. And that's another reason they're going to be hurt by getting into the market, isn't it?
Correct. No, and the point there is that the reason why first-time buyers are struggling is because prices are, you're right, in some areas moving up again from those lows. But both from a multiple of income perspective and also from a cash flow perspective, because effectively banks still have an obligation to look at people's cash flows. More people are finding it more difficult. So actually, that's why we have more people trying to rent than ever before. And of course, the rentals are going through the roof, as I said, up 20% in some cases for new rentals. The number of people who own their property outright is falling, and the number of people who have a bigger mortgage as they go into retirement is rising. So we've got this massive debt burden on us, with interest rates rising, which is why I'm arguing that this is not all a bed of roses, right? Which is why I say you've got to be really careful. If you're going to buy property now, don't overcommit. If the banks say you can borrow this amount, well, just make sure you can, and ask yourself what happens if rates go up, because the chances are between now and the next sort of 6 months, the RBA will have to put rates up again, and they will stay high. I think they will stay high probably for the next year or two. And when they come down, they will not be down at 0.1% again. They might be 3 to 4%.
You're making a huge one there. You're saying they're not going to come down, and they may even go up a bit. Right?
And the reason I'm saying that is because inflation is not behaving the way that the Reserve Bank wanted to see. Oil prices are now very much higher. If you look at petrol at the pumps now, it's gone way back up again. The inflation rate, of course, is driven by that, plus other high costs, the cost of energy and those sorts of things. We're losing some of the positive base effects that we had. In other words, we had big rises previously that dropped out. Well, now we're having other ones coming back in. And if you look at it carefully, the chances of the inflation rate coming back to target over the next few months has dissipated quite significantly.